Good evening, everyone. Let's start with the editorial news. Markets read between budget lines. To cheer up investors, government may be banking on two things: RBI cutting rates and easing liquidity, and India US trade deal getting signed relatively soon. In the best of times, the budget is much ado about relatively little. Certainly, in terms of its core idiom as a summary of government accounts and articulation of government's fiscal strategy, it has far less impact than the kerfuffle suggests, with nearly 80 to 85% of expenditure comprising salaries, pensions, subsidies, and debt servicing being non discretionary in nature. The biggest outcomes are mostly outside of the budget in terms of journalistic exuberance. However, the budget is a guide to government's economic policy thinking. Today, India's economy seems to be a Schrodinger's cat's construct. On one hand, as RBI governor has done, one can conclude Indian economy is in the rare Goldilocks period of high economic growth and exceptionally low inflation. GDP growth is expected to be 7.4% this year, while inflation remains benign at around 2%. Funnily, though, the commonest complaint is it doesn't feel like a 7.4% growth. Nominal GDP growth is expected to land around 8%. This is the second year running when nominal growth rate will be in single digits. Given that most things people earn, salaries of workers, revenues of companies are measured in nominal terms, robust GDP growth seems oddly at variance with the feel factor. There is another variable that skews the Goldilocks version: sustained foreign investor apathy, both FDI and FPI, in a growth hungry world. Why are foreign investors not flocking to a Goldilocks growth economy? From the budget, it would seem government is betting on Goldilocks economy to be the default case. As a statement of intent, it has laid out that can be best described as more of the same. Gliding towards fiscal consolidations, move of government expenditure towards capex supply side reforms, that's been the path post COVID, and this year has been no different. Government is meeting financial year 2K26 fiscal deficit target by cutting down on a range commission of expenditures as tax revenues have fallen short. Problem is, despite sticking to this strategy for 5 years, the fundamental nutcracker of low private capex has not been solved. Despite a booster of twin tax breaks, GST and income tax last year, private capex has just not budged. The picture gets more muddled if nominal GDP growth falls to 8% next fiscal. Like it did this year, the budget assumes 10% nominal growth, as fiscal calculations depend on that, but should be the nominal rate fall to 8%. Not outlandish at all, given the world seems to be awash with Chinese good because China is willing to do what it takes to maintain its global trade market share. Government may have tougher choices, especially because here is the Damocles sword of the 8th Pay Commission, expected to kick in from FY28 as a fiscal grey swan. Last but not least, state governments are heavily saddled with welfare commitments, hugely popular cash transfer programs that elections have been won on. Hence, extremely tough to reverse. The one time tax buoyancy bonanza has also seemingly played out. In a nutshell, there isn't much headroom between a commitment to fiscal consolidations and ability to pump prime the economy via a fiscal. On top of private capex anemia, there is now capital markets sentiment. While headline indices have held up, there is a significant amount of cuts inflicted in the broader markets. FPI flows have been negative. Domestic HNI flows have been sporadic and often frozen. MFSPI mutual fund systematic investment plans have held the fort. What is also eye popping is the disinvestment target at 80,000 crores. It is nearly double of last year. Sans retail investors' confidence sustaining, there is no way that target can be met halfway. Even more puzzlingly, government was confident enough about retail sentiment to have gone ahead with further hikes in STT on derivations. At the margin, a sentiment dampener. A matrix of outcome action strategy therefore points to something else, and that is about what is left unsaid. One, there is expectation and confidence that RBI will do a lot of the heavy lifting, which means a larger open market operations interventions to provide more bond market liquidity than last year. More crucially, find a way to ease liquidity conditions in the face of foreign exchange outflows. Above all, deliver rate cuts. This will, of course, test the overall systematic capabilities of RBI and bond markets. Second, there is an even chance that a trade deal with US has been agreed upon and is now close to getting signed. Of course, it's borderline heroic to depend on any commitments from a Trump administration, but there could be well firm indications that a deal is now ready to be signed. A trade deal will provide an immediate sentiment and a medium term macro boost via trade and capital flows. In the Sherlock Holmes mystery Silver Blaze, the famous Baker Street detective solved the case by picking on the dog that didn't bark. The most prominent pointers from the budget are resounding sounds of the silent confidence in the unsafe. In that likely lies the most important takeaways of this budget. Thank you so much.